Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me on the market site desk, we have Michael Normyle, Nasdaq's U.S. economist, as well as Chris Dearborn and Max Cabasso, managing directors on Nasdaq's Market Intelligence Desk. We're here to talk about rates, how stocks are reacting, particularly after the inflation print we got this morning. And Michael, I feel like the pain that consumers feel day to day, it's starting to actually hit the data in really real terms here.
Yeah, and it's pretty much been the same story all year, where at least headline CPI has come in higher than expected, January, February, March, and now today. And it's really been a lot of the same culprits, especially housing inflation has been more stubborn than we were hoping. And then you've also got things in airfares have in general been higher than expected this year. Same thing for car insurance, car repair, and also some medical costs as well too.
Well, I feel like it's in areas such as insurance, Max. I mean, we were talking about that off the desk before. To me, that is pretty glaring. I mean, we're seeing auto insurance, home insurance, and it's not something you can say no to.
Yeah, especially again, like if you're fortunate enough you own your house outright, you're not required to, but anybody and the vast majority of consumers own their house with a mortgage on it, and you're required to have home insurance. You go down to places on the water, especially down in states like Florida, you're seeing super high rates for home insurance where the cost is getting prohibitive. People potentially looking to sell their homes because that cost is so high. It's not something you think of on a day-to-day, like going to get a cup of coffee or going to get food, but that's a big expense, and as that keeps going up, that's going to hit your spending and your available cash to go out and spend in the economy.
It's like 22% year over year.
22%, yep.
Up. Well, Chris, on the Markets Intelligence Desk, just for some context here, you talk to our consumer/retail companies that NASDAQ lists, right? On the high end, on the low end as well. What are you hearing from companies in terms of how they view consumer habits?
Right, so we've had some conversations with some of the issuers recently, and we've talked about this in the past, that they're starting to see some chinks in the armor there. Regardless of how well wages are rising, regardless of the unemployment prints or non-farm print last week, unemployment rate of 3.8%, the baskets aren't getting bigger. People are not sizing up. You're seeing, if you go not just from the retailers, but also to the restaurants, people aren't trading up. They're not moving from fast food to fast casual. And when you're looking at that, you're kind of like shaking your head, like, what's the issue here? So you're seeing tighter credit across the board for a lot of consumers. Inflation's absolutely impacting them. And what you're seeing is the moderation in discretionary spend, and that's hitting almost all the retailers across the board, whether you're at a discounter, whether you're into beauty, or one of the other aspects there as well. And you're seeing a lot of the senior management address that on the earnings calls that we just had. And a lot of the companies got hit because they're downsizing their forecasts for the year. They expected to see a downturn, a lot of them, and what they're doing is they're kind of pulling it forward. Maybe we see a rebound, I don't know. But again, the data will tell us what the data says, but the issuers are bracing for a worse year than what was originally expected because of the consumer spend not being there, even though you have numbers like from the NRF saying that retail growth is going to be from 2.5% to 3.5%. Last year we saw 3.6%. Get a gangbuster year before that, obviously, on the COVID rebound. We're not the new normal yet. We were talking about that before, right? You have a spike up, spike down, and it's still looking for that normalcy. We're in that second downturn before it starts to come back up, and inflation's sticky.
Yeah. Well, Michael, you'd pointed out in your note this afternoon, a strong economy does help companies, it doesn't help inflation, but we're seeing stocks, with the exception of the trading action we see today, stocks and rates rise simultaneously, which traditionally isn't the relationship.
Right, until recently,
right.
At least, right? For most of this year, we've seen markets pricing fewer and fewer Fed rate cuts. We're down to, I think, 45 basis points in rate cuts today. Earlier this year was 170, and yet Nasdaq 100's up 7% this year. It's just the last couple weeks where we've started to see, stocks really moving sideways more so than still moving up along with those rate cuts. So it seems like maybe we're getting to the point where higher for longer is starting to offset the economic resiliency that we've seen.
Yeah. Well, let's pull up a couple charts here, Max. Let's start with the S&P and see that it's been digesting the news that we've seen. I also want to point out as well, we're going to start to get into earnings again, right? We're in this vacuum, or we were in this vacuum where we were hyper-focused on what's happening with the macro. So let's take a look at the charts. What's the price action confirming here?
So we really started to roll over. We peaked at highs end of March, and then we kind of chopped around for a bit. As you see here, 8-day moving average of 21, they're converging. We've really started to turn negative there. The 8-day is just above now. It's about 3 cents above the 21-day moving average. So again, those short-term indicators are pointing lower. Our next stop is probably that 50-day, just under 5,100. Below that, you probably have some room to go. Again, down to the previous all-time highs before we broke out here, about 4,800, 4,820. So again, one of the problems when you have that sharp upside move like we had to start the year, I mean, it's a good problem to have. You see these big moves, but you get a bit of a vacuum if you move lower. So again, we still have a few spots here, looking for some support. But again, we're right now in that kind of macro vacuum where everything's macro focused. And now with earnings start to come up, obviously guidance will, continue to play a big role. We'll see how much companies are starting to, discuss potentially the rate impact. Are they focusing on, or is it something that they're going to be able to work through? Get it to more of a micro level where we start to see, outperformance in some of the, names that are really working, and the ones that aren't are going to get hit harder. But again, we're in that bit of a macro.
Well, and that's why we see the Russell down over 2% today, because they're clearly more sensitive to higher interest rates. But let's take a look at the 10-year here as well. I think what's interesting, certainly over the past couple of years, is the velocity in which rates have moved. Yeah.
And you could see it today. A huge move here today. Previously we really didn't see moves like this. Just a week and a half ago, we were down at 4.2-ish, just below, and now we're over 4.5% again, really breaking out. We have some room, over 4.75% up to 5% potentially if this move keeps going. And again, you see these candles. This is rates, right? This is a 10-year rate. You're not expecting bonds to move like this, on something so large. I know the 10-year auction today was pretty sloppy, so it wasn't a great auction. So it's definitely, picking up some volatility there. And again, that 4.5 level is a big one, and we broke right through it this morning, bumped up against it and went right through it. So there's definitely, room to keep going here, especially with, potential Fed meetings coming up, what they're going to say. I know the minutes came out. But again, if June looks like it's off the table now, do we start to see another one come off? If, PCE coming out soon, there's definitely room to the upside here now that we broke through this 4.5% level.
Right, and of course, Michael, you point out earnings season is about to begin, so we're really going to have to weigh, are stocks more predisposed to what's happening with the economy, or if earnings fundamentals are what's going to drive the tape over the next 5 to 6 weeks?
Yeah, I think that's, it's always nice to have something other than economic data for markets to respond to. And I think, if Q1 is we're looking at positive growth right now, that's the expectation. And if you see the kind of normal case where stocks, most of them end up beating, then it's going to be even more positive, and that could provide some, benefit to stock prices there. So
general consensus is there's expectation for Q1 to be at least a decent quarter?
I think so. That's what I've seen.
Yeah. To Max's point on the charts before, I looked at a number of the larger and smaller indexes as well. And you mentioned the S&P testing the 50. You got the NDX testing the 50, the comp, and the mid cap, which made an all-time high. But on the flip side, you're talking about the small caps. The Russell, the S&P 600, the Russell microcap, all trading below the 50 days. The S&P 600 is going to be testing the 100-day moving average soon, but the Dow is also broken below the 50-day average. So when you look at that broader move today, and if you just look at today, the majority of companies are down. I think you have 8, maybe even less right now, the Nasdaq 100 companies trading in the green, but NVIDIA is up over double digits today, carrying that index higher, or else we would be down a lot more than 1% because of the weighting. When these stocks start to roll over, if they do, there's going to be a significant draft lower because because of the run-up we've had. There's such a large percentage move between the 50-day and the 100-day. You could throw the Fibonacci's on there, whatever matrix that you want. There's a big gap in support. You're going to hit buckets of there, but we could be lower significantly if this breaks here by a large chunk across the board. The small caps are already there, and they're breaking. Financing is going to break them. If the rates don't come down, it's going to happen, and the large caps are going to meet the top 1% of the stocks are going to move higher. The rest of the market, the 493, the S&P, is going to move lower.
Right, will be a continuation of kind of what we've seen, where everything kind of looks rosier from the view of hey, look, the indices are higher, but it's a few names that are really carrying it.
Right.
Does that continue? Do they even pick up even more momentum and say, okay, wait a second, we were kind of playing on that small cap reversal. We thought that was going to close the gap. Small caps outperform some of the large caps. That hasn't been working. You see people kind of throw in the towel and dump money back into kind of what's been working, like the NVIDIAs of the world, super micros. Okay, these have really been working. Let's stick with it until they stop working, and you might see that even break out even further, that divergence.
Okay, but by the way, the other 493 returned an average of 8% in just one quarter. You think about that on an annual perspective. I'll take 8% on a quarter.
Some of them giving that back already.
Right.
Right. I mean, I would think, why not put your money into a 5% risk-free rate right now? You know, I can get 5% today on my 2-year. I get 4.5 on the 10, right? Am I going to take that risk into the marketplace? Something happens. You know, it's very geopolitical right now. I mean, the oil number is definitely the only reason oil is up for the way it is right now before the driving season is geopolitical, right? That is the main reason right now. You know, housing is going to work itself out at some point. It probably won't be a this year item. It might not even be a next year item. You know, the food basket continues to climb higher. You know, your real inflation over 3 years is up almost what, 20%, give or take?
Yeah,
right?
A little bit more even.
Right? So you're looking at real money coming out of the people's pocket and what's wage growth over 3 years.
It's the thing is though, we have seen positive real wage gains. So it's, of course, it hurts every time you go to the grocery store, right? And you remember what it used to cost, and it's not like that anymore. So even though people's wages have gone up in a kind of commensurate fashion with inflation, it doesn't feel good still that you're taking all that extra income to cover the higher inflation.
Right, you would think your extra income would go towards something a little bit more discretionary than putting food on the table here.
Like my car insurance bill, which is going up again.
Yes,
right?
well, especially if you have a male driver that's in mid-20s, as we're all very well aware.
Or 2 of them.
Yes, same boat as you. Max, let's take a look at the VIX for a moment here. On a percentage basis, certainly quite the move that we've seen month over month. And we know when the VIX is at lower levels, those move higher feel a little bit more extreme.
Again, last year, look, we're up, 1.3 points, but again, that's 9% based on the lower levels. You know, again, this started beginning of April, so last week we had a close above 16, really for the first time since I think it was November of last year. So we've been in really kind of dormant, VIX levels. We've seen a couple spikes. We had one in February where we kind of got up above 17.5, but it didn't close there, came back down. So beginning of this week or beginning of last week, we saw that close above 16 for the first time in months. We're back up there again today. We kind of came off and then back up again. So there's definitely some fear, picking back up. The bull bear indicators, everybody's bulled up leading into this. Last time we were here, we were kind of talking about it was after the Fed had come out and all indications were that they were going to cut. And, I was kind of trying to digest it. That didn't really make sense. And everybody's like, well, it sounds like they're trying to cut. Everybody's kind of bulled up like, okay, they're going to cut. We're going to follow them. Don't fight the Fed. And now the data's come out, and it's like, wait a second, maybe they can't cut. As much as they want to, June might be off the table. What's going to happen the rest of the year? As much as they want to cut, we know what's coming up with an election and everything. There's that uncertainty that's picking back up again. And now, again, with rates moving higher, you can get that 4.5%, 5% risk-free rate. Say, wait a second, I'm going to need to get paid a real premium here to be in stocks if that rate is sitting there waiting for me risk-free. So you're going to need to get paid more. Again, with that uncertainty, again, back above 16. And look, historically still pretty muted compared to what we've seen. As you could tell, back in 2022, we were over 20 essentially the entire year. So now we've been in closer to single digits than 20 for a while. But like you said, we're up 9% today. So we'll see if that starts to pick up. We've seen some put action in the options world really start to pick up. People starting to buy some protection finally. For a while, the move had kind of gone back to a few years ago where it was, all right, just sell vol, take in your premium, and you're fine. And that's worked. And that works until it doesn't. And when it doesn't, it gets nasty.
Yeah.
So we're starting to see it definitely start to pick up. I wouldn't be surprised to see it move back over 17.5 if this sell-off continues, throughout the rest of the week.
It really feels like the dynamics have shifted, though. Certainly the conversation relative to the past couple of weeks, where there is a higher level of uncertainty out there. But I also feel like, with the exception, let's call it 4 months in aggregate of earnings,
right,
the rest of the 8 months is just picking apart, perhaps, there's just such a micro focus on what's happening with the macro, if you will, outside of those 4 months in aggregate.
It's really a hyper focus, right? I mean, this is really going to test the Fed's disinflation narrative right now. Luckily, the CPI doesn't carry as much weight in their minds as the PCE, but it goes hand in hand. I'm confused, but again, since you had to pivot back in Q4, it's just a push and a push and a push. What Kashkari said last week is kind of playing out this week, right? Maybe we don't need cuts this year. And that spooked the market. The market was having a great day that day, and we rolled over significantly. I think it was last Thursday when he spoke?
Yeah, Thursday or Friday.
Thursday or Friday. And the markets rolled over very significantly from there to the point where we closed lower. If that plays out, and if the hawkish narrative comes back into focus, us talking about the 50 days, the 200 days, the 16 VIX, we're going to be at a 20 plus VIX We're going to be testing the 200 days before you know it. There's going to be a handful of stocks that people are going to plow their crowded trade into, and people are going to be buying protection to the downside, and you're going to see money that came out into the money market funds and from short terms roll right back into it. And that's not going to help housing. That's definitely not going to help mortgage rates. That's not going to help this market. And that's what you need. And then you come into the election.
Well, Michael, if we take the curtain back behind Fed policy, do rate cuts really make that much of a difference? Will they be able to, get back into some normalcy, if you will?
Well, it's going to take a while, right?
Right.
Because the famous long and variable lags of monetary policy, right? So,
Well, is that what we're feeling now? Everyone says it takes 9 to 12 to 18 months for policy to impact the economy. Isn't that where we are?
well, we haven't had any change in policy since last July. So at this point, it's we've been seeing stronger than expected data, not the kind of potential slowdown that you would think from the full weight of that 5.5% Fed funds rate at this point. But even if we start to see 75 basis points in cuts this year, like the latest Fed forecast showed, whether or not that's obviously not what markets are looking for anymore, that's not going to be a huge impact on the economy, not this year and even next year. It's still going to be elevated relative to where they see the kind of long-term rate at. And I think like you were saying, the inflation is confusing right now. It's a bit of like a Rorschach test where you've got PCE at 2.5%. So that's pretty close to their target. If you take core CPI and take shelter out of it, that's 2.4%. So you can kind of twist it around and find good signs still in there. It's just that it's taking longer than expected, for sure.
Well, you have to remember, too, the market's not the economy and the economy is not the market. So if the market digests,
Forward thinking.
right, digests rate cuts as a positive thing, to your point, being forward-looking, it doesn't mean the economy is just going to snap back and inflation goes back to where it was before COVID. Not that that's going to happen anyway.
The economy's good. I mean, it's really good. You're seeing sectors start to break down a little bit, but they're not breaking bad. They're just slowing down, right? GDP forecast is still good. Earnings growth is still good for the large cap companies, not so much for the small caps, but not terrible, right? And you have alternatives to buying stock, right? Tina's out, right? You've got alternatives. So that's good for investing. That's good for the markets. And if you're making money, if you have a job, you have a paycheck in your pocket, maybe it doesn't go as far as it used to, but it still goes a decent way. So maybe your basket, like the retailers were talking about earlier, maybe their baskets aren't as full, they're being more selective, but people are still spending on certain things, the squishy stuff like the Super Bowl parties, Valentine's birthdays, things like that. They're just not going out and buying Junior Mints at every movie.
Interested to see though what happens with oil. Obviously, everything that's going on in the Middle East, starting to see headlines expecting a strike from Iran and Israel at some point coming up. Again, they said imminent. What that means? Do we see triple digits on crude? We're getting certainly going to enter the driving season shortly as weather starts to pick up. We're getting to the summer. There's going to be higher demand there. Do we see triple digits there? What's the downstream effect on that? Does that actually then hit consumer spend in discretionary areas where you kind of had that extra, you had a bit more of a buffer, and now if gasoline around here goes back above call it $3.50, $4,
and you don't have the stimmy checks anymore. That's
you don't
what
have
will
the
keep
checks
people
anymore.
afloat.
Insurance is going higher. Just the transportation aspect of everything. Does that start to even pick up even further? And again, curtail some of the spending you might have elsewhere.
All right, we'll cover that next week for sure. Appreciate the insight, everyone. Thanks for joining us on Trade Talks. And thanks for joining me from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.